Good day and welcome to Modiv Industrial Inc.'s second quarter 2025 conference call. All participants will be in a listen-only mode. Should you need assistance, please signal a conference specialist by pressing the star key followed by 0. On today's call, management will provide prepared remarks, and then we will open up the call for your questions. To ask a question, analysts may press star and then 1 on your touch-tone phone. If you are using a speakerphone, please pick up your handset before pressing the key. And to withdraw your question, please press star, then 2. Please note this event is being recorded. I would now like to turn the conference over to John Rainey, Chief Operating Officer and General Counsel. Please go ahead, sir.
Thank you, Operator, and thank you everyone for joining us for Modiv Industrial's second quarter 2025 earnings call. We issued our earnings release before market open this morning, and it's available on our website at Modiv.com. I'm here today with Aaron Halfacre, Chief Executive Officer, and Ray Pacini, Chief Financial Officer. As the operator noted, we'll start today's call with prepared remarks, and we'll open up the call for your questions. Before we begin, I would like to remind you that today's comments will include forward-looking statements under the federal securities laws. Forward-looking statements are identified by words such as will, be, intend, believe, expect, anticipate, or other comparable words and phrases. Statements that are not historical facts, such as statements about our expected acquisitions or dispositions and results of our operations, may vary materially from those contemplated by such forward-looking statements. Discussion of the factors that could cause our results to differ materially from these forward-looking statements are contained in our SEC filings, including our reports on Form 10-K and 10-Q. With that, I'd like to turn the call over to Aaron Halfacre. Aaron.
Thanks, John. Welcome, everyone, to the second quarter 2025 earnings release. I think in past practice, I'll just hand it over to Ray first, and then I'll add some comments, and then we'll just kind of get into questions, and I assume we'll have some this quarter. Ray?
Thank you, Aaron. I'll begin with an overview of our second quarter operating results. Revenue for the second quarter was $11.8 million, compared with $11.4 million in the prior year period. This 4% increase primarily reflects the impact of 2 industrial manufacturing property acquisitions since June 30th, 2024. Second quarter adjusted funds from operations, or AFFO, was $4.8 million, up 22% when compared with the $3.9 million in the year-ago quarter. The $900,000 increase in AFFO reflects a $576,000 increase in cash rents, a $217,000 decrease in G&A, and a $126,000 decrease in preferred stock dividends. AFFO per share increased 12%, from 34 cents per share in the prior year period to 38 cents per share for the second quarter of 2025. The increase in AFFO per share was less than the 22% increase in AFFO due to a 1.2 million increase in diluted shares outstanding, which reflects 895,043 Class X operating partnership units issued during the first quarter of 2025 and 344,119 Class C operating partnership units issued in connection with a property acquisition in March 2025. Cash interest expense for the quarter was $255,000 less than the comparable period of 2024, reflecting a decrease in the weighted average fixed rate as set by the respective swap agreements from 4.53% at June 30, 2024 to 4.25% at June 30, 2025, along with a decrease in unused commitment fees that resulted from our decision to reduce the size of our revolver. Now turning to our portfolio, our 43-property portfolio has an attractive weighted average lease term of 14.4 years. Though the majority of our tenant credits are private, approximately 29% of our tenants or their parent companies have an investment-grade credit rating from a formally recognized credit rating agency of BBB- or better. Annualized base rent for our 43 properties totals $39 million as of June 30th, 2025, with 39 industrial properties representing 81% of ABR and 4 non-core properties representing 19% of ABR. With respect to our balance sheet and liquidity, As of June 30th, 2025, total cash and cash equivalents were $5.8 million, and we have $30 million available to draw on a revolver. Our $280 million of debt outstanding consists of $31 million of mortgages on 2 properties and $250 million of outstanding borrowings on our $280 million credit facility. And we do not have any debt maturities until January 2027. Based on interest rate swap agreements we had entered into during January 2025, 100% of our indebtedness as of June 30th, 2025, held a fixed interest rate with a weighted average interest rate of 4.27% based on our leverage ratio of 48% at quarter end. As previously announced, our board of directors declared a cash dividend for common shares of 9.75 cents for the months of July, August, and September 2025, representing an annualized dividend rate of $1.17 per share of common stock. This represents a yield of 8.1% based on the $14.44 closing price of our common stock as of August 6, 2025. I'll now turn the call back over to Aaron.
Thanks, Ray. I kind of said in the press release, this quarter was a little boring. I would say, for me personally, it was probably a little frustrating. But I think hard work and patience can be frustrating at times. And it was boring in a context, probably on a relative basis to others, and as well as to our past quarter, right? So we didn't choose to be very active this quarter. We obviously got the lease extension in Northrop. We've been working on some things. We certainly did. We're pursuing a particular property right now, but the process doesn't fit neatly within a quarter. And obviously you've seen our share price. I think almost to the day, 60 days before the Russell inclusion, when it's pretty much known and calculable that you're going to get in, we fell off a cliff. So we were in the 16s, and we've been in the 14s now for about 90 days. So our exponential moving averages are now sort of set to those levels, and we're going to be disciplined. We're not going to issue. We didn't issue any at those prices, and we won't. And so it was a quarter where there was a lot of volatility. There was a lot of opportunities to buy. I think I probably purchased, 4,000 or 5,000 shares myself. It's ridiculously cheap. I mean, I think one of the analysts probably has the implied cap rate, but it's like in the mid 8s. And there's no way you can buy these properties with any handle. They're low 7s or mid 7s. Some of them are high 6s. So it's comforting in that regard, but it's also frustrating. That's the troubles of being a small cap name. And again, patience begets patience, right? And so we're playing a long game here. Not much to report. I'm sure we'll talk a little bit about Claire and the questions. I'm sure you'll talk about some of my comments that I've made in the release. But it was a solid quarter. I think the decisions we've made repeatedly and consistently is why we had a large beat. And so the decisions, even the absence of activity this quarter, my belief is that that'll pay dividends when we're talking this time next year, right? And I think that's the process, is just to be really patient, understand our strengths, understand our weaknesses, be able to maneuver nimbly and quickly as needed. I think there's a real need for what we're offering out there, and I think we're starting to consistently build a tribe. It's a retail tribe. It's increasingly an institutional tribe, but it's largely a retail tribe where people, they like what we're doing. They like the no bullshit. They like the consistency. They like the effort, and we're seeing traction there, and we like that. So even though I'm a little frustrated with the quarter, I would love to be a bigger REIT. I would love to be able to do more things. I mean, that's but I don't want to do stupid things, and you guys don't pay us to do stupid things. And so we're going to do smart things, and we're going to keep doing them every day of the week. So with that, let's operator, open it up to questions.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Remember, should you have a question, please press the star key followed by the number 1 on your touchtone phone. You will hear a prompt that your hand has been raised. Should you wish to decline from the polling process, please press the star key followed by the number 2. One moment, please, for your first question. Your first question comes from Gaurav Mehta of Alliance Global Partner. Your line is now open.
Yeah, thank you. Good morning.
Good morning.
Hey, I wanted to ask you on some of the remarks that you made in the earnings release about asset recycling. It seems like environment is getting better for you guys, maybe getting closer to sell some of those assets. Can you maybe provide some more color on I guess, what you're seeing as far as recycling, and then the $150 million asset that you mentioned, what kind of asset? Is it going to be 20% non-core that you would sell?
Yeah, it's a good question. Questions. So the assets that we would sell would be largely legacy assets. So these are they could be core and non-core. So a bucket of the non-core is in process, right? So as you know, KB Homes is under contract to buy Costco. We expect them to extend at least one extension. That one is it's in process. It's just a matter of timing. And the reason why they would extend is that they're just finalizing the paperwork with the city. And it's a reminder that I think they're 1.7 million hard money already. And so that one is one of the non-cores that's in the process of liquidating. We've mentioned in the past, OES has an option to purchase the property. They are in the throes of their very lengthy appraisal process. And so we don't think that would even self-liquidate the earliest until next year anyway, just given the process. And this has always been known to us and always communicated. So those I'm not talking about. Those candidly are not going to be accretive spread. I mean, we can liquidate them. They'll produce cash, but you're probably treading water after you sell them and replace them. Some of the other ones we're talking about, these are, I'm not going to call them out specifically because we have to be strategic about when we take them to market. But there are some assets that don't quite fit our box. Most of them are industrial. They are legacy assets. Would be very accretive. So they would be selling in high 5s, low 6s, and we would redeploying these in the 7s. And so and they're fairly liquid, and they're also properties that we've also received unsolicited offers in the past. And we've kind of gauged the unsolicited offers because, one, if someone goes out of their way to make you an offer, then they clearly find the property attractive. And then not every property, no one's doing that for Calera, so we understand the difference. And we've been able to note over periods of time how those cap rates that have been unsolicited have tightened. And so we think that, kind of in the broader picture of this pivot point that I talked about, that we're starting to see a little bit more fluidity in people's desires to do things. And so now maybe, or be approaching the time to start doing that. And so that's probably, I think in fairness, to talk about that at a big level, that called $150 million of proceeds, which I think, could generate close to 100 basis points, if not more than 100 basis points of accretion, has given us calm, right? Because if we didn't have some of that and we're trading in the 14s and we're not issuing, and, we would be like really in a box, right? I don't feel the pressure to be in a box because I know I have these things like we're still shaving off expenses, we're getting tighter, we're growing AFFO, we're doing all the things that we need to do. We just may not be acquiring a ton right now, which is like, the cocaine of the REIT world. And we're not doing that, but we feel comfortable that we have additional levers to pull. So I don't feel any despair. I don't feel the frustration I talked about earlier, just because I just like to grind. I like to do shit, right? And that's the frustration. It's not like, oh, we don't have any options. We have options. We're being patient. We're being disciplined. I think that's why we don't worry about the share price right now. We're not, verklempt. I believe that we will see that recover, and I think the recycling of those assets will help do that. Me mentioning it means that we're poised. We're thinking a lot about it. We've been thinking about it, but we're thinking the timing is right. It does, just to be clear, it does not mean I've already launched something, right? And if I do a recycling, you will know it. I will tell you when it's done. But we're getting to that next stage, which I think is probably over the course of the next year or so, that makes them the right time to do that.
Okay, thanks for that perspective. Maybe a follow-up. I think you also made some comments about the lending market. It seems like you are exploring, even though term loan is not expiring until 27. You have been exploring different options. Just wondering, I know you said there's lending available, but just wondering, what kind of terms and rates are you seeing in the market?
Yeah. So, I like to work. I'm very blue collar. I just like to work. I've never really developed any other habits other than maybe running and working out a little bit, but I don't golf. I just like to work. And so in a quarter where you have to be patient and there's not a lot of grindy stuff to do necessarily, I'm going to spend that time thinking, 12 and 18 and 24 and 36 months down and just iterating what could go here, what could go there. Like, so I'm a big, as you guys all know, I'm a big fan of REIT capital market history. I know what REITs have done in the past. I love this industry. I've been in it for a long time. So I spent a lot of time. And look, there's certain things, we're not reinventing the wheel here. And so during this quarter, I spent a lot of time. One of the natural things to do is to say, okay, we've got on our event horizon, we have a term loan maturity, a credit facility maturity. And so let's start talking earlier. We've talked to, obviously our bank syndicate, we've talked to others. And look, we are seeing that the environment for a new term loan / credit facility would be the same or better than what we had. That I think that helps the fact that we've shown tremendous AFFO growth over the last 3 years. The balance sheet has become very solid. We've, remember when we put that first term loan on, it was pre-listing and we still had a shit ton of office. So we've really transformed. So I think the lenders feel good. And I think we're exploring the full gamut of how to finance, right? Because to me, I like data, I like optionality, I like to understand what are all the choices. What if I do this now? What does that mean later? So we feel encouraged. We're going to be taking more steps towards that. I think the wild card clearly for anyone here is what are the broader what's the Fed going to do, right? Are we going to see Treasuries come down? We're going to see SOFR come down. We're going to see that. That's going to drive the needle, and look, you see it. You see we're robustly levered small cap name, and then there's a Fed fart in the news, and we whipsaw, right? And so that's, if we do find rates coming down, which I think everyone's going to make their own bets over the course of the next 12 to 18 months, and that's going to be a positive. Right, but as it relates to the terms and the structure, we do not see anything negative in our conversations. And if something comes up that changes that, well, then you're going to hear it from me. But right now, we feel encouraged by it, and we are early. I think I don't feel any pressure about I know some people get really sort of contemplative about maturities that are 18 months out, but I feel really good about this. We're in we got 14 plus WALT. And that includes things like, the 2 months on solar, and that included, right, the shortening of Costco. You remove those things, our WALT's more like an 18 or 19-year WALT. So the real core portfolio is solid with bumps and growing, and so it's very attractive to the lenders.
Okay, thank you. That's all I had.
Thanks.
Our next question comes from Craig Kucera from Lucid Capital Markets. Your line is now open.
Yeah, good morning, guys. You had a pretty sizable pickup in income recognized from your joint venture, or your TIC interest, I should say. Can you give us some color there and what to expect going forward?
Ray?
Hello?
Yeah, that reflects the impact of extending the lease. The way straight line rent works is, you're in the early years of a lease, you're picking up rent that's going to be received down the road. So, that was a 10-year increase in the lease term with 3% annual bumps. So that's what's driving it.
Okay,
I'd say that what we're, as we've noted in prior quarters, we are in active dialogue and discussion with our TIC partner. It's important for us that we in a timely manner end the TIC. There's a variety of ways to end that TIC, but TICs are a throwback of probably the pre-GFC construct, and you don't see a lot of TICs anymore, even though there's some around, and they're just not as fluid for a REIT. And so our goal longer term, and longer term is longer than this month, is to get rid of that TIC, and we will get that done one way or another. And so that will change a little bit of the dynamic, but there shouldn't be any more pickup now that we signed the lease.
I got it. That's helpful. And changing gears, you took the impairment charge. Looks like that was taken on the Calera equipment. I guess, are you moving closer to maybe a sale there versus trying to lease it, or is that just to?
Yeah.
How are you thinking about that asset?
Yeah. So we've had it's on the market, and we've had a variety of things people going through. And so what we've learned increasingly, I just don't know that I want to lease it. I think we want to sell it and free up our capital and redeploy it. I think that what we've learned over time is that there's as many different types of growing technologies as there are growers, as there are leafy greens. And so the growing technology that was in this equipment is now progressively several years older, and we're finding less of a market for it unless you find that particular growing style. So we decided to take the impairment against that. Doesn't mean that we might not find a buyer that values it, has some residual value, but we just figured that was a cleaner way to go. And yeah, our goal is to. My ideal context is that property's gone. If I have any powers within me to get rid of that property by the end of the year.
Got it. When the tariffs first started being announced, you had mentioned that your discussions with them indicated that they really thought the impact would be limited, but I'm curious, kind of as they've been shifting around in the marketplace, and you're looking at their financials, are you seeing that case as you have the discussions with your tenants?
Yeah, so we're just now gathering. There's always a little bit of lag, so we're just now gathering second quarter financials from them and doing our analysis. But so the ones that we have seen, and it's a good chunk of them. Yeah, one I'd say too is we really haven't. I mean, the tariff dance has just kind of been kicked down the street this summer, and so we have really not seen a ton of definitive tariffs until early this week or last week. But the impact has been as we underwrote, right? That I think there's not been any cost squeeze. There's not been anything like that. I think what we have, the commentary we've noticed, and it's a forward-looking, so you don't see it in the numbers, is some of them are saying that some of the bigger capital decisions that their clients are opining on or deciding on are a little bit delayed because everyone is waiting to see, well, what does the world look like, right? And so that seems normal to me. And so the conversations are, it's not that their clients aren't pulling the trigger, they're just not ready to pull the trigger yet, right? So we haven't seen it. I think there's, again, I still don't know exactly where Canada shakes out, right, on this. But the countries that have announced, we don't really have exposures to. I think the China deal, if it gets solidified the way we think it's going to get solidified, I think that's probably a win. And so I just don't see an issue on tariffs for our particular set. Doesn't mean that they're not going to be impacted, but they're not going to be disproportionately impacted from what we can see.
Got it. I want to circle back to Costco. That lease was scheduled to expire at the end of July. Can you give us a sense of the annual rent they were paying, and did you receive the first extension fee from KB Home?
KB has until August 15th, so we've been in conversations with them. They've told us they will be doing at least one extension. They may be doing two, and so they're targeting some possibly closing in December. And the reason is purely logistics with the city. It is not sort of a contemplative thing from what we've gathered. It's just the city has got a process. They have personnel that have been taking vacations and doing this and that process is taking longer than, and you can't push a string. So they have another 8 days before they need to, officially do the extension. We expect them to do that. The rent, Ray, do you have the rent on hand that Costco's paying?
Yeah, it was running about $2.4 million.
Got it. Finally, for me, late last year, you're looking at a number of transformational transactions you didn't close, but they were still potentially out there and may come back. Are you looking at anything out there that's similar, or any other large portfolio transactions?
I would say that transformative transactions are still definitely on the table. I think for all parties, it just needs to be the right environment, and it feels like we could be getting closer to environments that are conducive to those. So there are still conversations, but they're more the last first half of the year, they've been sort of more checking in conversations, right? Because a lot of moving parts, and it's just really really hard for teams and balance sheets across the spectrum to pull triggers and make decisions without maybe a few data points a little bit more solidified. So I'd say they're still on the table. I think they have to be too, right? Because we can't just stroll down the lane and do this little bitty stuff forever, right? We're too small of a REIT, so we have to do something transformational at some point. I don't think it has to be today, but if we were a $150 million market cap REIT in 5 years, then you should shoot us, right? This is not how the capital markets work, right? And they never do work that way, right? Unless it's someone who's not interested in shareholders, unless someone who's just that's not us, right? We care about our shareholders. That's all I am as a shareholder, even though I'm the CEO. All my compensation is shares, right? So so we're completely aligned in that regard. And so transformative transactions probably will never be done. Just not going to bring them up unless they are baked this time.
Got it. I appreciate your candor. That's it for me. Thanks.
Yeah. Uh-huh.
Your next question comes from John Massocca from B. Riley. Your line is now open.
Good morning.
Morning.
It's always kind of a difficult question to ask in this context, but I think given the answers you gave to the last question and some of the commentary on the earnings call, do you think there's maybe an opportunity, given some of the loosening of capital broadly out there in the markets, to maybe market Modiv in its entirety as kind of a portfolio and platform, or either or?
So I've talked about this before. Look, we and I think I did it in the context when we released our appraisal. So every year we get our portfolio appraised. It's a tradition we had when we were pre-public as a non-traded REIT, right? And where we were, unlike a Blackstone REIT or a Starwood REIT where they have liquidity windows. That's what we used to have. We used to have sort of liquidity windows, and we would have set arm's length in appraisal. And we continued that tradition on, even though there's a little bit of cost to it. I think it's been useful. And I think the last 2 years, it's been roughly $24 a share, right? $23.75, $24, something like that. And look, that's done by Cushman & Wakefield, very respectable. But if you look at sort of NAREIT sort of indices, you look at relative to NAREIT, we know there's lags. So look, I'm not here to suggest to you that I know for a fact that we're worth $24 a share, but I sure as fuck know we're worth more than 14. And we're going to work diligently to close that loop with the actions that we can take. And I've said, and I think I stated this in February, if someone comes over the top and can close that value gap definitively, then we have to listen. That's our duty. That's our job. Are we going to go solicit that? I don't think that would make the most sense right now, because candidly, if I was going to solicit and go sort of, and again, believe me, this is the board decision, and I'm just one member of that board, is that, soliciting that would mean that we're waving a flag that we think that we capitulated, and I don't want to see predatory sort of characters coming into play, right? I can remember back when we were at $9.53 and we were at like fucking 3,000 shares trading. It was a mess, right? We were just, this was early, like late 2022. We had a lot of people sniffing then, but they wanted to go pay, $10 a share. It was like fly kite, right? Because in 4 years of dividends, that's like half the value you're saying. And so we understand that this is a tough time in the broader market, small cap REITs in particular. We're holding up relatively well. If you look at us compared to some of the other small cap REITs, and look, for various reasons, I look at Plymouth, and I look at Good, and I look at Pine, and I look at FrontView, and I look at these guys, and we're holding, other than when we fell off a cliff right before the Russell announcement, we've been holding up pretty well, and I think that resonates to the tribe. And so our view is we're going to keep climbing that mountain, we're going to keep delivering dividends, and we're going to try to close that value gap. And smart money will know that if they want to close that value gap sooner, we're going to listen, right? And so I think that's the approach we're going to take, because I think our investors deserve us to fight for them, not to have hubris, not to be ego. Like if I lose my job tomorrow, so be it. That's how I set this up, right? So it's so hard to do things in REIT land. We're going to be smart about it, and we're not going to be obstinate about it, but we're not also going to be, begging.
Okay. And then how do you kind of think about understanding that kind of in the volatile kind of capital markets and, cost of capital moving around, you have to be mindful of that and the impact that acquisitions and the like have on bottom line results. But how are you thinking about maybe weighing that against, right, the positive impacts of increased scale, either on your valuation as a public company or maybe even based on what we kind of talked before about maybe being more attractive as something, for private capital to come and look at?
Repeat that question a little bit again, a little bit more simpler. I couldn't follow you quite. What is the question?
Well, I guess so. Right. Obviously, you've passed a lot of acquisitions. You're trying to make smart transactions, given kind of where your cost of capital is. But there's also an argument to be made that, right, part of the reason why your cost of capital is where it is because you're kind of subscale. And so, how are you kind of weighing those two against each other? And I guess does that also maybe impact your attractiveness based on kind of what we were previously talking about?
Got it. Yeah. So I think our attractiveness, if we continue to do our job, which is to increase value, we'll only continue to be attractive, right? If we do what's right for the shareholders, which is don't make stupid decisions, grow the money, protect the house, get it to be more valuable, then those will always mean that we'll be attractive. We could triple in size tomorrow and we're still bite-sized, right? So I think from public or private spectrum, we are going to be in that box of always someone's, appetizer for a quarter or the meal for the year, depending on the size of the other five. We're always going to be on that thing until such time that we are not. And to me, in this market, I think that unless you are $1 billion market cap or larger, you're in the food chain, right? So I'm cognizant that our existence is going to be one where we are always going to be, a rabbit, and people are always going to check on us unless the REIT gods line up and we kind of suddenly are huge. But I don't have any ego to do that. My sole purpose is to increase the value, and so what we do during the day-to-day is we make sure we take decisions that increase the value. Because if we, recycle legacy assets, and we have, I think, 1 or 2 double net leases that we didn't acquire. If we recycle shorter WALT stuff, and we end up being a very ironclad battleship of a WALT of 18 years and a clean balance sheet, and we're operating well and we're smooth, that's just going to make us even more attractive and more valuable. And then in the meantime, while we're doing that, our investors are getting paid a dividend. So give you an example. Let's just say, Wild Blue REIT came tomorrow and said, we want to buy you for $15 a share. We'll be like, well, that's not much of a premium. And, and they wanted to pay cash. I imagine our investors would say no. They'd say no because chances are in 2 or 3 years, we could at very least be worth 15, if not more, and we'd also have made over $3.50 worth of dividends. So that economic value becomes 18 or 19 or 20. And so I think for us, we're going to stay our course. If we keep doing the right thing, we're going to continue to be more valuable. And it's just, either we'll get there. And, I don't think it's a matter of, we're not, and I bring this up on the office thing. I mean, even the office people are getting bids, but we're not office, right? We have actually a very attractive portfolio, and we're cognizant of that. But our mission is solely do right by our shareholders. If we do that, everything else would get taken care of.
Okay. And then on a much more kind of micro basis, the property in Washington with KB Homes, is there any risk that the city doesn't zone that for KB Homes or some kind of regulatory reason that falls out? I'm just thinking, is the delay purely kind of bureaucratic inactivity, or is there some kind of debate going on in the municipality as to whether to greenlight that project or not?
So
it's purely the bureaucracy of the city. I mean, they have entitlement rights that the city can't disregard those. It's zoned to allow additional housing.
Yeah, the zoning's already there. This is sort of a plan approval. I believe it's bureaucracy and logistics. That said, there's always, I think, until what I do know for sure is there's 1.7 that they can't get back. Do I have concerns that they're not going to close? I don't, but probabilistically, there's some small probability weighting that is an outcome until it's done, right? I think about all probabilistic weightings. I think it's it's on a tail. There's a lot of kurtosis in that assumption, but I don't think it's happening.
Okay, that's it for me. Thank you very much.
Great, thanks.
There are no further questions at this time. I will now turn the call back over to Aaron Halfacre, Chief Executive Officer. Please continue.
Danny, it looks like we do have a question from Steve Chick. Do you want to go ahead and get that?
Yep, one more question from Steve Chick of Cebus Garden Capital LLC. Please, your line is open.
Hey, thanks. Just to clarify on the $150 million of recyclable assets that you've kind of soft circled, the Costco property, the $25 million you're expecting from Costco, isn't in that. And can you kind of highlight how many properties that kind of refers to?
No, I cannot, or I will not. Let's put that. I surely can, but I won't because. And the reason is that if you're taking these properties to market, you want to preserve a little bit of the, because we are a public company, right? And anyone can go read up on us. And so we like to preserve a little bit of that optionality. Suffice to say, they're legacy properties, and they are properties that don't quite fit our box, but they're very attractive properties. That's what I will say. And it does not include the KB or the Costco, excuse me. The Costco right. One, yeah, the Costco one is like, it's great that they're buying it. And, if you recall, there was other home builders that bid on that process. They were the top bid. So the destiny of that property is to be, a housing for people in a housing constrained market. So we feel good about that. I don't think the proceeds from that, they don't move the needle, candidly. After we pay back the loan, it's not a ton of proceeds. It should be good to be free of it and move on because that was technically an office. But these other ones we're talking about these are things that we've, again, received unsolicited offers for in the past. They would be construed as very liquid. And so that sensitivity on a recycling, and so which no one's asked really is, because these are legacy properties, they all have very low tax bases. And so you have to think about them in terms of 1031 exchanges. And to do a 1031 exchange so you don't incur a tax liability, which is a no-no for a REIT, is you have to be very thoughtful and very line things up. And so, part of that is, what do you replace them with is just as important. I think the decision to sell them is an easy one to do. It is not one that will take long, and I do not think that we'll be wringing our hands worried about the resulting cap rates that we get for them. I think the more thought comes in is, okay, how do we sequence and place them into something that's really going to make the portfolio more valuable? And so that's the other part of this equation that we're starting to see come into play is that you go back fourth quarter of last year, first quarter of this year, there was just not much inventory being available to acquire. Certainly not like we like. I mean, some deals are getting done, but some of the deals look like crap. And it's like, I don't want to buy a crap deal just for a crap deal. So I think what we're seeing is a little bit of the fall. It's also starting to see people say, hey, we're willing to go put our properties out again. And so now it's giving us the other side of the equation, because we could have sold this $150 million of properties a year ago, probably wouldn't have suffered that much on the cap rate side, but we would have had trouble deploying. And I think so it's a balancing act there. But suffice to say, legacy properties, valuable properties, things that should move fast.
Okay, that's very helpful. And then the second, if I could, in your comments about kind of the numerous unsolicited overtures they've received for your properties, you kind of also, you say and beyond. I'm just kind of curious. I don't want to look into that too closely, but I mean, does that mean the market around you, or have you gotten overtures that are beyond just sheer properties?
You read it pretty accurately.
Okay, great. Thank you.
There was no double entendres there, so doesn't mean it's increased, right? Sniffing, that's how I would describe it, right?
That
Obviously, if
that's helpful.
if there's something that was, very, very specific and very formal, then that would be a different type of disclosure.
Right. Okay. Thanks, guys.
Uh-huh. All right, Danny, I think we're there. I will run with it now. Everyone, thank you so much. It's so much more enjoyable to just answer questions. I've been reading so many earnings releases, the transcripts. I can't suffer going on people's calls anymore because all they do is read things, and they just regurgitate what was in the queue. And I know that's protocol, and I know that's probably the best way to go, but it just does not work with my personality. And so I prefer these questions because there's more insight. And, the job for me to have a dialogue with an analyst or an investor is to help create understanding. Again, our balance sheet's pretty straightforward. There's only 43 properties. Most of you guys have the numbers down. What you're trying to do is get into my head, right? And to the head of Ray and the head of John and everyone here to see how do these people, because, what are my motivations? What are our proclivities? What's our past history? How all these things that everyone has that makes up who they are make the impact of decisions, right? And so, as a reminder, I think I'm like an 8.9% shareholder of the company. I have put all my eggs in this basket. I watch this basket 24/7. I love thinking about it all the time. I treat every dollar that's in there as if it was my grandmother's, God rest her soul, she's not here anymore, my grandmother's money, right? And damned if I'm not going to screw that up. And so that's how we think about it. And I think it's refreshing. It's refreshing to me. And I know increasingly we get comments from people that, Wall Street people are looking forward to seeing what Aaron's going to say. Because look, I'm a bit uncharacteristic in my writing style and maybe my speaking style, but I hope it resonates. I'm preaching to deaf ears on one side and a tribe on the other. But let's just get this done. Great grind, back to the grindstone, and we'll see what comes of the next quarter. Thanks, everyone.
Ladies and gentlemen, that concludes today's conference call. Thank you for your participation. You may now disconnect.